So, hello and good afternoon. I welcome you to today's Trading Spotlight webinar. Here together with Admirals on Friday. It's the 11th of June, 2021. Yes, I had to, you have probably seen it. I had to prepare something. We're using another folder now in the background, and I just had some trouble to get the presentation going as I wanted to wanted to let it go or let it run. And so I'm now using the slide or the folder or the file from my laptop here. The only problem was that I made already adaptation in the presentation, which was uploaded in the file. But what was or could not be seen in the file I have here on my laptop, and it's an important one. It's in regards to the risk disclaimer, and so I had to change this. But still, we have a very special topic today, and the trader gods were with me. So in fact, what we want to cover today is a setup which you can use and adapt accordingly. And what's interesting is that it's on how to profitably day trade Forex, day trade FX here. And it needs adaptation. So the basic setup itself is, especially in the current environment, probably not so interesting, not so great to trade, because FX has seen a massive drop in volatility right now. And the approach I want to present to you is on breakout trading in general. So which means you need a certain level of volatility in the markets. If you don't have the volatility, then it's likely not to work well. But again, coming back to the trader gods at the beginning, I mentioned, so today the basic setup went really well. And so that being said, brings us here then to today's presentation and some thoughts on how to profitably trade FX. So this is the first slide. One thing I'd like to mention right at the beginning. So if you're watching this now, the recording, which will be uploaded in the YouTube channel from Admirals, then please, if you enjoy what you're seeing, leave a thumb up here, leave a comment in the chat box below. If you have any questions, and I could imagine that there will be questions after that webinar here. So then please feel free to ask them directly here on the video, or respectively below the video you're watching here on YouTube. If you have any questions now, right here in the live event taking place via Zoom, feel free to ask your questions. I'd be more than happy to answer them. And yeah, so that being said, brings us now to today's topic, how to profitably day trade Forex. Before we start, first of all, here some rebranding taking place. We mentioned this already, and still it's noteworthy. Admiral Markets is now Admirals, or getting closer to being Admirals exclusively or solely. Let's put it that way. You know Admiral Markets as a global financial service provider, especially in terms of FX and CFD brokerage. Forex CFD broker with more than 8,000 financial instruments being available. But over the years, Admirals decided to take steps to have a more, let's call it, global approach and become a real true, not just multi-asset broker, but real true financial service provider with several financial services being available, like a credit card, for example. And that being said, brings us then to the rebranding currently taking place from Admiral Markets to Admirals. As a trader, nothing changes, so it's just a name, but just that you get an idea on why Admiral Markets is now Admirals. And yeah, so that being said, check out the website, admiralmarkets.com, check out their offering in general, especially in terms of the DAX. I think it's one of the most, if not the most competitive offering. Here in Germany, usually we refer to Admirals as the DAX 30 expert, with typically 8.8 points spread here in this context, but also very competitive offering when it comes to FX trading. There's some third-party websites. I think I mentioned this in earlier webinars, compared the spreads here on average in the FX space when trading with Admirals. So long thing short, admirals.com, check out the website for further information, and feel free to reach out to their service, available in different languages. And I am 100% sure that you will find someone in your native language. Also something noteworthy, by the way. So I think I worked in the retail client right at the beginning of my career in the banking sector, in fact, and that was very. There were clients who just wanted to talk to someone in their native language, just felt comfortable, and so I can fully understand that. And with Admirals, you have a global broker here with global presence and a high chance to reach someone in your native language to ask all your questions and get all your answers. But now let's have a look here at today's agenda. So first of all, what we want to do is we want to give an introduction to breakout trading. Just some rough thoughts on this. Most of you, especially the more advanced traders, probably will know about this, what breakout trading is about. Then after that, we want to give some real world examples. So breakout trading is not just FX related. I will give also an example on the DAX here. In this case, we can also exchange DAX with S&P 500, for example. But our main focus here today will be on the FX space. And that brings us then to our Asia Breakout FX trading setup. In this context, give you some thoughts on this, how this looks like. You can check it yourself, by the way, and I highly recommend doing that to get a better understanding of the parameters I present to you. Check out today's chart. Again, very small range, but worked perfectly well. So there was some pressure in euro building, and you saw the market moving straight away after the breakout right into the take profit level, and bringing this trade from today into the take profit. That's not common, let's say. So it's not a 100% holy grail strategy. That's not true. So the overall hit rate can be found between 47 to 48%, depending on market conditions. Right now, low volatility, it's performing. It's not performing optimally, let's put it that way, but definitely something to consider and probably broaden your overall experience here in terms of FX trading. So, and then I will give you also some thoughts. I said this is a basic setup I will present to you here. I give you some ideas on how to optimize it, and I probably give you also some deeper or give an impulse for some deeper thoughts for your trading in general, how to read price action in a certain way and what to make out of this. First of all, now let's start with an introduction here to breakout trading. And in this context, I just want to go through this quite quickly, in fact, what a breakout is. So a breakout occurs when an asset, for example, as today here, like an FX pair, moves above or below, above a resistance, respectively below a support level on increased volume. Increased volume is something which is here noteworthy. It's no coincidence that it's underlined. Increased volume means we really need an idea on, is this a true breakout or not? And when, for example, looking at equity markets, trading stocks, for example, you have an exchange where these stocks are traded, or let's put it that way, the blue chip companies, especially the Teslas and the Neos and the Apples and so on and so forth. And here, that being said, you can have now ways, you can find ways to give you an idea on the so-called relative volume, the R-vol in this context. So what does it mean? It means that you can now say, for example, you have a time span, let's say between 3:30 to 4:30 PM German time in this context. For example, this is usually the time when US stock indices open, NYSE opens, and usually you have an average trading volume during this time of, say, let's say 5 million shares in whatever stock it might be. And then now for the day, when you look at the trading day and this stock is right now hot, what you could say is, if now, for example, the average trading volume is 15, or no, the volume for the day is 15 million shares, that means that the average volume, 5 million shares, is today way higher than usual. So that means you have an R-vol of 3, because 50 million shares were traded between 30 and 45, 3:30 and 3:40. So within these 10 minutes. And that being said, it shows that, well, there's really like market participants are looking at this stock right now. Now the problem is, and this brings us back to today's presentation, because it's not on stocks, but it's on FX. We don't have accurate volume in FX markets, since FX is a mainly OTC traded market. It's over-the-counter product. So there's no centralized place like a stock exchange here, for example. And so that being said, brings us here to our solution. What we want to do is, we know, coming back to the elevated volume aspect, that elevated volume usually goes hand in hand with increased volatility, not increasing volume, or elevated volatility goes usually hand in hand with increasing volume, that way around. What we need to keep in mind here is we want to see at least a so-called min range. So that means that we want to see the market moving in a certain width percentage wise to consider a breakout to be interesting. And so that being said, for example, could mean that we say we want to see at least a min range of 0.3% of the currency pair. Let's say you have Euro USD, for example, and here in this context, you have 120. If you say 0.3, you want to see at least a trading range here, in this case, of 36 pips, for example. 2.2, for example, usually sometimes you go for 0.2, you say 24 pips. So min range here in this context should be 25 pips. If it's less than that, it shows that there's not much interest in the currency pair right now. There's not lots of volatility, decreasing volume, obviously, or that being said, there's a likelihood that here the breakout is probably not going to work. And this is how you could use then this approach and adapt it accordingly to the market you're trading, the asset class, where you don't have the volume as we have in FX. And to trade breakouts, we first of all need to identify a range. So which means we need a range which is based on a time frame or clear support respectively the resistance area, where the traded asset FX pair in our case built support respectively the resistance zone. And then what we want to do is we want to trade in direction of the overall advantage once a breakout occurs. So that being said, for example, let's say we have an overall uptrend, as we currently see, for example, in equities. Just look at S&P, for example. So right now we have a very volatile, low volatile market environment and a tight range forming. If I'm not mistaken, in the S&P, it's somewhere between 4,180, if I'm not mistaken, and 4,240, or a little earlier was 220, I think, 40 points. And then we yesterday pushed to new all-time highs, at least small number here we pushed to new highs here in this context. And so that being said, we want to trade breakouts out of the range 4,180 and 4,220 here on the upside in this context, for example. So the overall uptrend is given, and that being said, we want to trade in direction of the advantage. So what this also means is we need to find ways to identify this advantage then in this context. So and what's great when trading breakout strategies, especially when you trade a breakout out of the trading range here, is that you have a clear level to risk off. So you have a clear level where you know the breakout is not working anymore and what to risk in this context, which means you have the width of the range, and usually you place the stop below, respectively above, depending on whether you're going long or short, above or below the range in this context. And this is the risk from your entry point then in this context, giving you a clear level where you know the breakout is not going to the breakout is not going to play out well if you're getting stopped out here. So potentially a so-called fake out. And well-known trading ranges here based on which breakout patterns are defined are, for example, the so-called opening range. So very interesting. These are the 30 to 45 minutes, first 30 to 45 minutes in the DAX 30, for example, or also in the SP 500, or the so-called Asia range. So in FX, in this context, where even JPY pairs in this context. So pairs which are Japanese yen related or connected, which makes sense since if we look at the Asian markets, usually you look at the most liquid currency during that time span, and this is the Japanese yen. And so even here, the JPY pairs are most of the time trading in a very narrow range, in fact. So that being said, you have clear levels to formulate your breakout ranges from, which breakouts you then want to trade. And these breakouts usually occur quite early in the day once London markets come into the market, which is usually the time around 7, 8 a.m. London, in fact, when the light here goes on, and here the city then starts to trade. And so let's now move over here to two examples out of the real world. So first of all, we want to have a look here at the opening range in the DAX. And here we have a look at the DAX on a 5-minute time span. Let me just check the dates. when did I do this screenshot? Is this 1 year ago? So you can see this happening over and over again. So I'm just a little irritated because 28th of May, not really sure because the structure here looks different. And as you can see here, by the way, it looks definitely different to the one we've currently seen in the market, especially when it comes to the DAX. But so what I did here was, in fact, I have my range in the DAX, which I define in this context between 8 a.m. to 9:05 a.m. German time. This is the high and the low in this context. And so why do I take 8 to 9:05 and not 9, for example? Well, what's the reason for that? So first of all, the institutional volume comes into the market from 8 a.m. German time. So that used to be the time when the FDAX, the reference market, also for our DAX 30 here, started to trade. And so this is now extended trading hours. So you will see that the future DAX is now traded at an extended trading range in this context. By the way, let me just check out one thing here. Let me just check one thing. This is very important. Hasn't changed. What I'm doing right now. So before we go here into the trading range, I have to, once again, you're probably already used to this now, because this is not the first time that you're listening here to the Trading Spotlight webinar. I have to prepare my trading here for the upcoming hours, and today is it's a strange day. So right now it's meme stocks like AMC, GME, and all this. They see some volume, but I'm kind of surprised. Probably you followed the price action, especially in GME yesterday. They delivered earnings, and then there was a interesting sell-off because numbers were quite good, and they also said that they are hiring former Amazon executives, which is not the worst sign, let's put it that way. And then they were massively sold all day long and really closed at the low of the days. And right now it's the stock is trading at a level where I say this could get interesting in the upcoming hours. But what I don't like, and this is exactly the point what we just mentioned several minutes earlier, what I don't like is the aspect that a hot stock, a meme stock, one of which is so actively discussed in a Reddit forum, and usually on average trading 15.5 million shares a day, is right now trading only 337K shares. So this is not enough. This is not action, but this is quite low volume, in fact, and this is resulting in some kind of skepticism whether this is of interest here. What different picture in another meme stock? It's called Wish, but here in this context, yeah, I don't know. The technical picture is not that promising. So what I do is now I collect the numbers, and if I have something here, I would probably make this a hot topic webinar somewhere in the future. If you're interested in seeing me then on how to trade this. By the way, if you like to see that, please type it in the chat box of this webinar, respectively also below the YouTube video. So probably this is of interest for you, and you want to get you through this process of what I'm doing, and then how I get these hot stocks then on my watch list, and what I look for in this context. But let's come back now to today's topic and the open range. So first of all, institutional volume, very interesting, because you can see that this connects. It depends on how you look at it, but to some extent it's similar every day what I do, and it doesn't really matter which trading which asset class I trade or what the approach is, even though the strategies differ certainly. But when talking about institutional volume, so right now, for example, Wall Street is not open. So you check the time now and say, well, it's 10 minutes till Wall Street open. So what is it doing there? I'm collecting, or I'm looking at the volume traded in the pre-market. I want to see where institutional traders are right now putting their money, if you want. That's the reason why I here, for example, look at the time span between 8 a.m. German time and 9 a.m. German time, where the Xetra Open takes place. So this is then when spot markets open. This is like 9 a.m. German time. When the DAX opens, is like 3:30 right now, p.m. German time, where the S&P 500 in this context, NYSE, is opening then. And that being said, here gives a quite good idea then on how important that the time span is, because here I can already see which levels institutionals traded against or traded off from. Now you wonder, okay, he talked about 9 a.m. German time, Xetra open in case of the DAX. Why is he looking at 05 then? So 5 minutes after the open? That's simple, because if most of the volume pours into the market at 9 a.m., there's some significant erratic moves on the up and down side, which is resulting in no significant breakouts on the up or down side, but instead it increases sometimes the overall range I'm looking at here. So I want to filter out the noise, if you want, by giving the market another 5 minutes to clearly show me where the ups, the highs and lows are, and which levels to trade up from. And so this is where, or how I define the range in this context. Let me just see. In this context, yeah, this is the rise, this is the high and the low here in this context, and then I have here the entry point. So we have the breakout on the downside below, what is it, 12,089 or something like that. And this is where I place my stop. And why do I place my sell stop in this context? Why do I place my sell stop? Just go back here one slide. Oh, let me just do it that way. Because now I have to identify the advantage. And what do? Is I look here at the EMA 50 on a 5-minute time frame. And what I then do is I want to see a closing price below the EMA 5 to say EMA 50 on a 5-minute time frame to say I consider the overall advantage being short. Respectively, here in this context, if we close above, then the advantage should be found on the upside. And so I have a buy stop order in the market then. In this context, you can see that's a close call, in fact. Short is only there because the 5-minute 9 a.m. candle closes below 05 in this context. And then the breakout happens here. And what I then do is I place my stop at the high of the range, while I place my exit point 2 R away from the entry here, which is reached in this example, obviously, to illustrate this and in further detail. And that being said, so this is the idea behind the breakout. So what you're usually seeing is then that the market, after it breaks out of a predefined range here, you see the market then gaining momentum in direction of the breakout. So this is what you want to see here, which becomes even more significant if this level here falls together with a higher time frame, another 5-minute time frame. In this context here, this is a little unfortunate. Let me just see if I can put this here. So can you still see that? This is surprising. Probably I take this out. Probably better. So the same what we do here in case of Euro JPY. This is the FX pair on the FX pair we want to focus on is Euro JPY in this context, and we do the exact same thing, but it's a different time frame. It's an hourly chart, but still you can see it's the same approach. So I have a time frame I look at here. In this context, I define the Asia range between 3 a.m. and 10 a.m. Central European time. In this context, why 3 a.m.? Well, this is once the Asian markets start trading. So you probably have seen that the Nikkei starts trading at 1 a.m. London time each day. So 1 hour later, it's 2 a.m. German time. So they then continue to trade till 8 a.m. Nevertheless, and this is probably then another thing you probably wonder about, okay, 10 a.m., this is a little late, no? Because not really, because we want to also here, we want to filter out the noise. We want to see the European markets moving in one or the other direction already. And this is exactly happening between 8 to 10 a.m. Markets finding a range similar to the noise filter, let's say, by giving the DAX 5 minutes more after Xetra open. And so here also, we identify the overall advantage with the EMA 11 on an hourly chart. And that being said, then delivers the same approach. So we have the Asia range, high and low here. We have, oh no, I'm sorry. Usually it should go, let me just see. What just happened here? Okay, it's the other way around. Okay, I'm sorry. So here's the entry point with the breakout of this range. So this is the high of the range. The hourly closing price is above, as you can see here, the exponential moving average 11 in this context. We go through the details here in a few seconds. But also here you can see the breakout happens on the upside. In this case, not on the downside, on the upside, market moves strongly in direction of the breakout and the predefined advantage here. And then we are working with an exit point, which is close to the 2.1. But data shows that the optimal, let's call it risk reward, we should work with delivering the optimal capital growth in relation to a drawdown, which occurs over time, should be 1.7 to 1 in this context. And so that brings us here to the key parameters of this setup of this trading idea. So what we do is we define the Asia range, so which means the highest and the lowest value in Euro JPY between 3 a.m. and 10 a.m. Central European time. So it means 4 a.m. and 11 a.m. EET, or it means 1 hour earlier. It means 2 a.m. and 9 a.m. London time. So depending on your time span, it should be based on Central European time, 3 a.m. to 10 a.m. So this is my time period I look at. And then what we do is we identify the advantage here based on the H1, so the hourly chart, EMA 11. So we place here, let me just go back. We place in our hourly chart, we place this EMA 11 in this context. And then what we do is we look where the last hourly close, what happened there. So if the last H1 candle in this context closed above, we consider the overall environment to be long, which means I only trade breaks on the upside of the range. And if the last H1 candle closed below, we trade only breaks on the downside of the range. And that's it, in fact. So the stop is then below, respectively above, depending on whether we are long or short, the high and low of the range. And our position, as I already pointed out, works with a predefined risk-reward ratio of 1 to 1.7. Very interesting to note in this context is, first of all, you wonder, okay, what happens if I have the range and then I have the hourly close, but we are not triggered? So we are closing within the range. And what happens then if, for example, the last hourly close, while not being triggered, was below the EMA 11, and the next hourly close is above, but we are still not triggered on either side, long or short? Then we switch this setup. So it depends. It switches, in fact, on whether we close, where we close with the last hourly candle, and then in the next candle we take the trade. So first of all, we need the hourly close to happen in this context to switch a setup, and then. Also very interesting to note is we are talking about a pure and 100% intraday trading setup. So which means if the trade is triggered and the market moves in our direction, or it doesn't, but we are not getting stopped out, doesn't reach the take profit level either, we take it out manually before US markets close, which is in my case 9:58 p.m. Central European time. So this is then, in fact, when you can expect, when you should expect volatility to really dry out, and volume drying out, because then also US markets are out, and we have, it's not just that window opening then from 11 p.m. Central European time, with then the rollover taking place and the spreads widening, but also Asian markets should be expected to open at 2 a.m. in this case, Central European time again. And then we have this dead window, which means once we look here at this intraday setup, you would no wonder probably, well, why shouldn't we take out the trade, let's say at 11 or 10:58, because this rollover period, this dead window occurs at 11 p.m. each evening. So why don't we take it out there? Because we can already see volume drying out and spreads widening with the closing of the US equity markets. And this being said, results here in a more favorable environment in which you can take the trade out than at 9:58. And also something to note, if the trade is not triggered, this could happen. Happens not often, but if it happens and we are trading within our defined range, we take the order out if it's not triggered on the up or downside. We take it out at 9 p.m. Central European time. So 1 hour before US equity close, which makes sense because we need an hourly close here to decide whether we go long or short. If we take out the order shortly before here, the next hourly candle closes, we should take it out then at 9 p.m. European time, Central European time, yes. So Okay, so that's in fact it. So we will go through this again in the summary. Let me just check. Do we go through this? No. So if you're interested to test it yourself, screenshot the slide, please. So this is probably the easiest way to have all those parameters. If you have any questions, again, please feel free to ask them. Type them in the chat box right now. Ask them below the video. If by the way, if you as of now like what you're seeing on YouTube, if you're checking it out, watching the recording, please leave the thumb up here. Would be much appreciated. But we're still not yet done. I could now say, okay, that's it. Have a nice weekend and enjoy the US market opening and then take it from there. But I think it makes more sense now to give the optimization here of this basic setup a deeper look. And what we could do to probably improve the overall profitability of this trading already, respectively, probably to also give you some hints, ideas on how to optimize your overall trading when it comes to other trading approaches, which you could handle the same way. And oh, that's a little unfortunate. So first of all, we already mean oh, just 1 second. The breakout happened until 9:05. It's the same approach. So that being said, I'm on the DAX. So we need to wait the 5-minute candle to close in case of the DAX from earlier. And at 9:05 and 1 second, this is the first time when we can trade or can take a trade. Okay, so this is the first time once we have a chance here in this context. In case the second question, I usually don't give out the presentations, which is I mean, I could do it. I could do it, but I don't think it makes so much sense. The reason for that is very simple. So there's nothing. Well, there's no secrets in it or something like that. So the video will be published on the internet and everyone can see it. But the reason I don't want to give out the slides is because it destroys the willingness from participants, listeners, readers, whoever access this slides then to think for him herself. So this is at least an experience I made over the years. So people say, I want to have the slides, and then it's done. It's like, I don't need to think about this anymore. I don't want to think about this anymore because I can look it up every time I want. And I think this is very counterproductive and something I'd like to avoid. So what I really what I really like is people saying, hey, I really want to understand this. I really want to get here in depth of what we're talking about and why this and that is the case. And I think this is countered to some extent if I give out the slides, because then you just say, okay, I have the slides, I save them on my laptop, wherever, and I want to say that I know that because I do it myself. I did it myself. Let's put it that way. So it changed over time. I just wondered, why didn't I look this up anymore? Why didn't I went into further details here and wanted to learn more about this? Because it was just like, yeah, I have everything available. I can look it up, and then you don't look it up. You find the excuse every time not to do this. And this is, I think, so I hope that you understand why I don't want to give out the slides. So it's not because I'm a bad guy or something like that. So or I'm a very lovely person. I'd really like to give it to you, but I think it makes more sense for you to go here through the presentation again, think about it, ask your questions, and yeah. So that being said, hopefully it answers the question. So now let's have a look here on the optimization. So first of all, only trade the breakout if the Asia range is greater 0.2%. So this is the first thing. Remember, higher volatility points to higher volume, which means nothing more than we have an increased likelihood that the breakout will happen in our direction. One reason why, for example, today, hard, because today's range was slightly below 0.2%. So we got lucky, let's put it that way. But it's something to note here in this context. So 0.2% means in this context, if Euro JPY, for example, and this is a setup, you can see or check it out yourself, whether it works on other FX pairs, but Euro JPY is the currency pair I know it works on. Check it out for GBP USD, check it out on Euro USD, check it out on, what do we have? Pound against USD. Probably it needs some adaptations. The basic idea is still the same. But here in this case, we are focusing exclusively on Euro JPY. So if Euro JPY trades at, let's say, 132.15, then the range should be at least 27 pips. If it's below that, I wouldn't trade it. And in here, case of equity markets, let's look back at this. I mean, we focus mainly here on FX, but still, you probably say, hey, this was something. I'm not the equities, I'm not the FX guy. I'm more like the equity trader, equity indices, whatever. Then also something to take into account. If you get access to real volume data, then in this context here, consider breakouts to be more likely to work if the RVOL here, so the relative volume I introduced a little earlier here, to be at least 2-to-1 in this context. Sometimes it depends a little. I mean, sometimes it's a more actively traded stock like an Apple or Tesla could be a 1.5 already pointing in one certain direction, but I prefer 2.1, 2-to-1 in this context. And then also in terms of finding the overall advantage here, we could also look at the so-called dominating time frame, in our case, the daily chart. So if we trade this on a daily, on an hourly chart, our dominating time frame is the daily chart. What I mean by that will be shown in the next slide. So this being said, it brings us directly to looking at the so-called accumulation, respectively, distribution area. And we need to introduce this. What we want to say is, if we trade here in the so-called accumulation area, what we want to do then is we want to aggressively trade, more aggressively than as if we are trading in the distribution area. Then if we trade to take, if we trade it at all, the setup here, then we should be at least more conservative in terms of our position sizing. So what do I mean by that? Therefore, let's have a look here at this chart. So what we have here is a simple idea on how a trend is built. And so what we could do now is we could say everything happening in here. So for example, if the market here is considered, this is the regressive move in this sequence of higher highs and higher lows. So this is then the green area is the so-called accumulation area. So this is the area where the risk reward is very favorable for traders who want to enter the market. So this is very roughly, but still it gives you a better idea on how to optimize trading. I know that Marcus, who is giving his daily morning show or a morning meeting, if you want, here for Admirals, is I'm looking at it from a similar perspective here in terms of accumulation area. I'm not really sure about his lingo being used, but I think the approach is very similar to that, because he tries to trade into the correction, if you want. So the idea behind this is the same. We are trying to increase our risk reward on the trade and get a more attractive payout for our trades, which we probably then take. And so that being said, brings us now to the idea of saying, okay, what does it mean? And therefore, let me just wait a second. I have to open here a slide. And I try to get you through this, and I just look here at the time. I have to hurry up a little, but still, it's too important. So probably we have a little more than the usual, let's say 45 minutes, but I think it's worth it. So let's have a look here at the daily, okay? And so what we have is a sequence of higher highs and higher lows, okay? So you will clearly say that this is an uptrend. And now what's getting interesting is, if you see such a corrective move, how does it look like on our traded time frame, on the hourly chart, this red line here? And let me just do it here that way. So how does the hourly look like then? Well, the hourly looks like this, right? So what we have is a downtrend on the hourly chart, while we have an uptrend. So the dominating time span, the daily is our dominator, if you want, we have an uptrend. So which means while we have a downtrend here, we should still consider long engagements given the overall advantage, which we can find here in the daily chart. So now the next question arises. Okay, it says, well, when is this sequence of falling highs and falling lows broken? When is this downtrend on the hourly chart broken? And there we can say it's when this last relative high is recaptured. So that's probably somewhere here. Okay, somewhere there. So what you now want to see is the market start to form a bottom and then trade higher from here. So let's put it a little different. Let me just do it that way, probably. So you now see the market break in the sequence, which looks like this here. And then what you want to do is you want to go long against this area to anticipate small bounce back here. You want to anticipate a break higher. So this is what you want to do, and how you can see the time frames playing with each other, and obviously strongly interacting with each other. So looking at an hourly chart should go hand in hand with having at least one eye on the daily chart in this context. And now you can see if you trade on a daily chart here, the breakout, and wait till it happens, you've already your position which you built here on the hourly chart. You have it in the profit zone already, and now are very comfortable here by seeing the market. You have, if in fact you're in a free roll right now, because you don't really mind whether we break higher or not, because you already had a chance to trail your stop to break even, and say, well, I'm not risking any euro, USD, GBP, whatever currency you trade here at all anymore, because I already trailed the stop to break even. Since if this is my R, which I look at here, if this is already earned, I can easily trail the stop to break even and say, well, I made at least one R, and now let's see. If we break higher, great, then I continue to make more money on the trade. If we fail to break and I'm getting stopped out, well, fine too, because I trailed my stop to break even minimum, and I'm not losing any money on this trade anymore. And that being said, brings us now to the presentation, back to the presentation. If you have this overall view and your range, in case of the Euro JPY, for example, your range appears here in this area. So this is based on your Asia range, based on the time. Well, we traded way more aggressively than it would if it's somewhere occurs here, and we already broke, which is somewhere here. If we already broke to new highs, why do we do that? Because it's likely that our dominator will see more bias and attract more bias and pushing the price significantly higher from here. So this setup here is more likely to work than it is once we already find ourselves in the so-called distribution area, in the area where market participants probably say, well, not really sure if I want to buy here because the risk reward is getting more and more unattractive. So that being said, here brings us to an idea on how to optimize this approach, this quite simple breakout approach, to the next level, and seeing different time frames then playing with each other, and profit from the knowledge you have based on your overall, for example, trend knowledge, let's call it. So yeah, that being said, hopefully opens a new window, a new door for your overall look on the markets. And you can see, if you understand that in depth, even though it was quite roughly and now only in 5 minutes, but you can already see how you can use this knowledge in your trading. It's not necessary that you use this as a trading approach, but it gives you a deeper understanding of what's happening in the market and how you could use this knowledge then in your trading approach. So use this analytical skill you just acquired, and then optimize your trading approach and increase the likelihood that, for example, a simple approach, a basic strategy like a breakout strategy is then working. And so that brings us to the summary. So first of all, let's come back to breakouts in general and how to identify them. So first of all, a breakout occurs when an asset like an FX pair, for example, moves above a resistance level or moves below a support level on increasing volume. The problem is, as we pointed out, we don't have accurate volume in FX markets, since FX is a mainly traded OTC traded market. So solution is, we know that elevated volatility usually goes hand in hand with increasing volume, which brings us to the first optimization part. We should say, okay, then we trade only ranges which have a certain with, like, for example, 0.2%, as in our case for Euro JPY. And in this context, Euro JPY is an interesting currency pair to trade breakouts. See the proven profitability in trading setup earlier. So if you trade this, Euro JPY is probably a currency pair to consider. And still, you have further ways to improve here to increase the likelihood of this setup working profitably for you if you have a deep knowledge around accumulation and distribution areas, which can help you then to improve, smoothen your equity curve when it comes to trading breakouts in general. And so here are, again, the contact details from Admirals, admirals.com, where you can find further information. I already opened, by the way, I haven't opened, but I will open it now, the web page to just show you where you can register for the next webinar, which will take place here on click, which will happen on or take place on next Wednesday. Let me just see. So there we have it here. So admirals.com, and then you look at education, and there's the Forex and CFD tab. And here you can now see all webinars which happen and we can register for. So how to properly day trade Forex, that was the one you just witnessed here. And now you can see here on Wednesday, I'll be here once again. And here you can register for the it's now, or is it now, the time to switch from growth into value stocks. So Tesla has seen a massive run higher, but since the beginning of 2021, the thing is that value has outperformed growth, in fact. And now the question is this a move which is here to last and to continue or not? And this is exactly what we'll look at. So this is the webinar you can register for. Just click on it and register here. So it's not the same, by the way, so not trading spotlight, but it's a hot topic webinar right now. And so yeah, that brings us back here again to the presentation from today. Let me just see here. There we go. Here's the risk disclaimer. Again, if you watch this on YouTube, please feel free to subscribe to the YouTube channel. Set a reminder for the next webinar taking place, which will be recorded every week. Leave a thumb up here. If you have any comments, please just leave the comment. Any questions, I'd be more than happy to answer them. And so yes, this is it. Happy trading. Watch your stops. Talk to you again next Wednesday. I look forward to it. All the best. See you.